Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab. And this is Long Verticals and Diagonals. And before the webcast launched, I see a lot of you welcoming back from vacation. Yep, I've taken an extended on and off leave just to go have some fun. But while I was on vacation, some of our example options trades got wrecked. So today we're going to be talking about trading. So taking some lessons from trading with half of a plan. So how might that have been prevented? How might a trader attempt to minimize their risk exposure, maybe even while stepping away from the screen? So it should be a really good discussion. Before we can get to any of that, though, let me first of all say hello to everybody out there in YouTube. A lot of familiar names chatting, and chat's really active right now. Great to see you all. Hello there, Josh and John. I Never Eat Here, Selva, Sharon, David, Danny, Rick, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, and there are a couple of those names that I've noticed there in the chat window that I don't entirely recognize, well, welcome aboard. It's great to have you here. Hope you'll join us each week. And if you're watching on the YouTube archive after the fact, just watching the recording of this presentation will enjoy the show, but be aware that you're invited to join us in the live discussion. This is a Thursday webcast series. We kick things off promptly at 11 Eastern. If you'd like to be here in the live stream audience, we'd love to have you. And I also want to let our live stream audience members know that my very good friend Brent Moores is going to be hanging out in the chats. Brent and I have been working together now for over 20 years. So great to have Brent's support there. Brent's just going to be answering any questions that I can't get to. So thanks for having my back, Brent. And Brent and I would also like to issue an invitation to everybody watching. If you have an account with X, give us a follow on X. You should be following your favorite presenters there. It's the best place to connect with your favorite presenters in between these live streams. So you can find Brent on X at Brent Moores CS. You can find me there at Cameron May CS. But that's it. Back from vacation. Time to face the music. Let's go talk about these trades that have gone wrong and get some lessons from them. But as we do, of course, let's first talk about risk. That's sort of the whole point of this discussion. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for the day. First thing that we're going to do, we're going to take a look at existing positions. We're going to take at recently closed positions and see how some of those have gone. Now, I have to say, not every trade went south on us while I was ignoring things, but a couple of them really did. So we're going to learn from those existing positions, those recent positions. Then we're going to look at the markets and plan a new trade, but a more complete trade. This one with a plan to try to mitigate that downside risk. And we're going to make that as mechanical as we can so that we don't have to provide constant oversight to that trade. So let's go right to the Thinkorswim desktop platform. And I'm going to start off with Amazon. Now, if we were to go to the monitor tab, you'll notice we just have two current positions here. We have Gilead and we have United Health. And by the way, one of those is going to be in this discussion today. It's going to be one of the points of this discussion. Yeah, UNH. But we've had a couple of trades that just hit their expiration since I left. So let's go to the charts, have a look at those. First couple actually just turned out just fine. So we have Amazon, which was a long call vertical spread. We bought 10 of the 185 long calls that expired here on May 16th. We also sold against that 10 of the 190 short calls, creating a long call vertical spread, where if we got assigned and if we exercised, we wind up buying shares of stock at 185, selling those shares at 190. It's a $5 potential reward minus the cost. The net cost of this trade, what did we pay for this thing? $22.40 minus $18.70 gives me $3.70 from my rough math, my quick math there. That will leave $1.30 per share on 1,000 shares, $1,300. And that $1,300 is now a realized gain in this paper money portfolio. What happened here is that while I had my back turned, we hit expiration right there on May 16th, well in the money, above the 190 strike. When the stock is up there above the strike prices with long calls, the owner very likely exercises their right to buy. In this case, we had a short where someone exercised their right to buy from us, and we exited that position for $5 after having paid $370 to get into it, $130, $1,300 maximum gain, and off Amazon goes. So that one's fine. It's not the point of today's discussion. We also had lows, which was the opposite direction. This was a long put vertical spread where we bought 5 of the 240 long puts expiring April 18th. We sold 5 of the 230 short puts. And this one, I talked about it. This one we were getting right close. This was discussed in our very last webcast. We were getting right close to that expiration. But this one was already solidly in the money. What happened here is theoretically exercise at 240, assigned at 230. We wind up having someone sell us shares for 230. We sell those to someone else for 240. It's $10 minus the cost to set up this trade. That's a realized maximum gain. This trade worked out just fine. Now, we also have existing positions, the first of which is doing just fine. This one's actually Gilead. And in this case, we have a series of positions that we've had. With Gilead, we bought a $95 long call way back here on January 30th. And as it's made its way up and down and up and down, we've been selling short calls against that. Now, since we last talked, we had one short call, this one that expires May 16th, just expired for another 81-cent profit. But basically, we've had 3 profits on this trade. We've had 2 losses. And then we have the current long call position, and that seems to be strengthening. So maybe what a trader might consider doing here, because we've had our most recent short call just expire, that just leaves us with 3 contracts of this long call that is doing quite well. You can see that paid about $16 for this. It's worth about 28, so we've nearly doubled our investment on this trade. What if we were to sell another short against this? I wonder, it looks like there's been a resistance up here at around that 117 level for a while. What if we could sell a call up here against that, somewhere in that range, maybe the 115, maybe the 120. Let's go see what's available on Gilead. And should we go out to the 43-day contracts? A trader could consider going with a shorter term, smaller premium, but they're not on the hook for quite as long conceptually. If they sell a short call for let's say the 20th of June, or maybe a weekly in between. What would the 135? Not much going on there. Was it 135? No. It was 115. Let's look at that 115 again. 115. No, what am I looking at here? Let's go back. Stock is at 111. Yeah, we were looking at 115 to 120. That's right. Okay, yeah. So that 115, slightly out of the money, somewhat out of the money. We could even maybe go up to that 120 level. Sell, looks like those trading between 220 and 233. Maybe we'll try to get 225 as we sell a call here. Let's do that. We have 3 contracts. So let's click on that 120 short call. Click on the bid price to create our buy order, our sell order. Let's dial that down to 3 contracts to match the number of long options that we have. And let's see, well, maybe we'll settle. I'm doing this in the interests of time. Let's say that we're willing to accept a little bit lower credit to hopefully improve the probability of a quick fill on this order. So there are pros and cons to doing this. I'm basically doing that because we got a webcast going, and I need to move things along so we can get to the real point of this discussion. But I'm gonna try to sell that short call for 220, set that as our limit. Even if we think we're being generous here, accepting a lower credit doesn't mean that the order is guaranteed to fill, but it does look like it's even trading below the natural at this point. But let's click confirm and send. Just because we say we're willing to accept that little of a credit doesn't mean that's the most we can get. That's just the least we can get and still have the order filled. So let's sell these 220. This is going to suggest that we have an infinite max loss. That would be the case if this were a naked call position. It's not. We're covered with that longer term option. We're just looking to bring in some credit here. There is a commission to be paid if this order fills. Let's send this off and see if we can get it done. So we go back to our monitor tab, look at our working orders. Looks like that's, we've offered to accept 220. It's trading for 228. I think that's going to fill here pretty promptly. I'm going to let it work though and move on. That trade's doing fine. I want to talk about the ones that are kind of misbehaving. Now, the first one has already been wrapped up. It's a position that we took on Broadcom. Let's go back to our charts here. Here, well, let's get our symbol in there. Oh, look at that. Okay, we filled at 220. Took a little bit, but we got it filled. All right. On Broadcom, let's just look back to when this trade was initiated, which was back here on April 17th. Broadcom had really been making lower highs and lower lows. It had just popped down below this sort of intermediate to longer term previous ceiling that had acted as a recent floor and was starting to head lower. So this day right here, you might see that was the technical logic of the trade. Now, even when a trader does what they consider to be their homework and they come to a conclusion regarding where they think the stock should be going, doesn't mean that the stock is guaranteed to go in that direction. So our projection here was that the stock may go lower. Well, we put on the trade. It started to rally, but this was after I did my last webcast in this series, and I just headed out on vacation. And here's what happened to this thing. Now, what I typically do in this webcast series is we don't automate the exits because I just come back the next Thursday, and if things are not going well, we talk about the management. If things are going well, we talk about the management, and then we just do it live while the camera's running. But that's not how life always works. Sometimes we want to step away from the screen. And in this case, I did that and sort of neglected this trade. And here's what happened. That thing just blasted off. It never recovered, never came back down below our strikes, which is where we prefer it to be. And we hit expiration solidly out of the money. These contracts just expired worthless. And let's see, I think we paid $3.70 between the long that we bought and the short that we sold. There was $3.70 of risk per share times 11 contracts, 1,100 shares. We took nearly a $4,000 hit on that one. So that is an expensive lesson about trade neglect, trading with basically half a plan. That's what kind of happened here. We knew the logic of when we were getting in. We never had the opportunity to discuss the logic of when we're getting out, and it just sort of steamrolled us. John says, why did it go up so high and so fast? John, I don't know. I haven't had a chance to get caught up on Broadcom. So I would take just a moment to do a little bit of quick research. If we're interested in finding the recent headlines about a stock, we could pop over here. We could use one of our tools. Let's just switch our gadget here to the live news. And then you just type in the symbol. And this will retrieve recent headlines. We can make those headlines specific to our stock of interest and just read down through. Right? There are other ways, obviously, that we get up to speed on an individual security, but that's one quick way that a trader might do that. Probably a combination of factors here that could certainly help. But there's a lesson to be learned from Broadcom, right? Are there steps that might be taken that might have at least minimized that? Now, I'm not saying eliminating risk. Risk is always present. We'd love to be able to trade options with no risk. I don't have a webcast plan for that. I just don't have any way to deliver that. But there are approaches that a trader might take to reduce the risk exposure. Now, it might be that our trader in this scenario was just perfectly fine. Some trades go against them, and the $4,000 played a relatively minor role in their portfolio, and that was an acceptable risk. That's one way to do it. It's to just not place trades that are larger if they go completely haywire than the maximum acceptable risk. Now, there are other ways that we want to talk about, but we also want to talk about United Health. This one actually wasn't trade neglect. This one was actually sort of digging in the heels on. So with United Health, just to revisit what we have going on here, we own a 520 call that doesn't expire until 2027. 589 days left on that. Now, against that, we've sold a shorter term option that expires in 43 days at a higher strike. That's the 530 call that expires on the 18th of January. That short option creates now a bullish call diagonal spread. The preference here is for our stock to go up, but get close to that 530 and ideally just come right below it. That would be the best case outcome. We've had a couple of those do exactly that. This one definitely has not done exactly that. Instead of going up toward 530, look at where our stock is right now. It's a $300 stock. We have the right to buy the shares for $520. Yeah, great, awesome. We have the right to overpay for shares by $220. This one has been dramatic and it's a great learning opportunity. So let's go have a look at this one. So I hope when you see a chart like that, you'd say, Cameron, why are you showing a bullish trade on a stock that looks like this? It's because back here, so here's our transition to 2025. There's the end of 2024, 2025. Right there on this little blue oval was when we started what were intended to be a whole series of trades on United Health. And the decision was made on that day. You know what? For better or for worse, we're digging in our heels and we're sticking with this trade, and we're going to see what lessons it has to deliver. And this one, I think the current lesson is, this is the cost of sticking with the trade when the original premise of the trade has long expired. It's long been demonstrated to just not be accurate according to how the markets have performed since then. So here's what we did. Way back then, January 9th, we bought that long-term call, that 520. It still doesn't expire until 2027, with the plan to sell short-term options against that. And that's what we've done. Now, these are our chart has been compressed by this strong move to the downside. I might even need to have to stretch this out just so it's legible. So here's what's happened with that long call, not doing well, as you would imagine. When we buy a long call that gives us the right to buy shares at 520, when the shares are worth 520, well, that's okay. When those shares then collapse to $300, look at this, it's down off the bottom because I expanded that vertical axis so much. That really crushes the value of that option. I think we paid $100 or so for those contracts, and they're worth like 15, something like that. What are they worth? Yep, paid 102. They're worth $15. That hurts. Now, we've taken a little bit of the sting out of this, and this is unfortunately what some traders can find themselves caught in, is that their original premise was so convincing up front that new developments never convince them to change their mind. And the focus becomes, how do I reduce this risk? How do I reduce that? How do I reduce the cost? How do I reduce the loss after the loss has already occurred? Well, I got news for you. Unfortunately, we cannot magically reverse some damage that the markets have delivered. The markets can come back and reverse that damage, but the trader doesn't have that within their power. So what could really reverse the damage that's been done to this 520 long call? Well, if the stock rockets back up, that could do it. Is that likely to happen? Probably not. Guess what? We're going to sit this thing out for the rest of the year and see. But along this way, are there steps that might have been taken if the trader is willing to admit when their trade premise has been proven wrong, and they can just cut it off and maybe stop the bleeding? John the Noble Savage says, I would have bailed. I think that, John, you're not alone, but this is where paper money trading can have some real valuable lessons, and looking back at things can be helpful in deciding, well, were there moments where if I had been paying attention, maybe I should have just said enough is enough? Well, our trade premise originally was that this upward sloping trend line was a technical indication that price is likely to go higher. Right here, you'll notice there was a break back on February 21st, a strong break of that trend line. Now, for some traders, that might have been the exit. What I will say is at that moment, despite the profits that had already been made on some short options, this would not have been a profitable exit. It would have been taking some lumps. Those lumps would not have been nearly so dear or severe as what we're sitting on right now. So I think lesson learned. But what I want to do with these lessons is take it as a positive and change behaviors moving forward. Now, these behaviors are going to have potential benefits and potential negative consequences. There are pros and cons to every trading decision that we make. So I want to make sure that we cover that. But we're going to be planning and placing a new trade. With this one, I'm just going to let it continue to work. The short option, it's already dropped substantially in value. I'm going to let that one get maybe another week closer to expiration. It is way, way out of the money, 230 bucks. So we're just going to let that continue to work. We're going to stick with this one because that was our decision on January 9th, and we're going to take that all the way through the end of the year. But in any case, we need to add a new trade to this portfolio. But that one, by the way, United Health is the one. Even with that $4,000 loss that we took on Broadcom, United Health is really the driver of the poor performance of this portfolio for the year. So let's go plan and place a new trade. But let's discuss this from the lens of a trader who wants a plan, not just when to get into the trade, but also when to get out if the trade is going sour. And we're gonna mechanize that process. So let's take a look at the markets first. If we're about to plan a new trade for our portfolio, one decision that might be made right up front is whether it's going to be a bullish position or a bearish position. So let's put ourselves in the shoes of a trader who's looking to maybe add a new position out here for July. Let's go to the July 18th expiration. June 20th, just around the corner. Let's go out to that third Friday of July. And how might a trader see current market positions? Well, since that April low, the S&P 500 has come up and pulled back. It's come up and pulled back. It's been stair-stepping, making higher highs and higher lows. And for some technical traders with momentum like that, they may choose to not try to fight that momentum. Instead, well, if we can just get that to continue into later in sort of midsummer, maybe we can just benefit from that. So we're going to be placing a bullish trade. Now, that's not the only way to view this chart. And there could certainly be other views of which way the S&P and maybe other major market indices might be headed. But I'm going to be placing a bullish trade today, but with a plan that if things start to turn bearish, we're going to be out. Anthony says, does the Schwab Coaching offer a one-to-one program? It does not, Anthony. That's tough to do with the demand that we would have. We have our little team of 8 or 9 coaches. Nope, couldn't do it. John, are you saying what kind of graph are you using? Are you talking to me, John? Because I'm just using the same candlestick chart that I've used for a long time. This is a 1-year daily chart. And these lines, oh, by the way, I know John probably knows that I drew these on, but if you're wondering where these lines came from, is there some nifty indicator that just pops those on the chart? No, I just drew them on using our drawing tools right down here. But let's find a stock and plan in place a bullish trade, but with a plan for exits. And for some traders, they consider that to be a complete plan. Now, I would say even with what we're going to be doing, it's not 100% complete, but we're going to be making it more complete, having a plan for when to get in, and also for having a plan for hopefully mitigating that risk exposure of the trade. So let's go to, let's bring up Google. So right away, you can probably see the technical logic of why I chose Google. For some traders, not everybody uses charts, but for those who use charts, one fairly common technique is to look at the short-term cycles that a stock or an index has been going through. Which direction are these cyclical lows going, and which direction are these cyclical highs going? And in this case, you can see that with Alphabet, we seem to be running through a series of higher highs and higher lows. And to some, that is the definition of an upward trend. And we're getting a little bit of a bounce today, up about 1%. Maybe that makes the trader feel good that that momentum is continuing. And let's say that our expectation is maybe we'll swing up to a new high. Could pull down to a low from there. But overall, this is sort of what we're envisioning may happen as we move toward July 18th. Now, obviously, time will tell. We don't know exactly what July 18th holds, but that's our outlook. And you'll notice that the recent low took us right down to previous highs. So let's say our trade, we're going to try to build that around the assumption that we're going to stay above 165. Keep that number in mind. But as you do, just be aware that for some traders, there can be other priorities beyond just what's going on a chart, or maybe setting charts aside entirely. They may emphasize things like the price per share of the stock. They may look at things like the liquidity of the stock and the liquidity of the options. There can be other things that sort of pre-qualify a potential trade candidate before they even start to consider it as something they're going to deploy their favorite option strategy on. Now, when I use the word favorite, the one that I'm going to be using today, don't take that to mean that this is my personal favorite. It's always just for education. All right. So let's go build a new trade, a bullish strategy. This webcast series is called Long Verticals and Diagonals. So we're going to do either a long vertical or a diagonal. We already have some diagonals in place. So let's go for a long vertical spread. So let's go to the trade tab. Let's look at that 18th of July expiration and look at the 165 strike and the way that we might construct a long vertical spread that could benefit if we're at or above 165 by July 18th is we could buy, let's say, a lower strike than 165, but with the plan of selling 165. So how about for this one? Let's just do a $5 wide spread. Buy the 160, sell the 165. Looks like that's going to cost us somewhere in the neighborhood. What's our difference here? About 370. Oh, that's interesting. That was what the one that just went haywire on us also cost, about 370. But let's do that one. Buy the 160, sell the 165. The way to place that trade is to come up here to where it says spread single, and we're going to change that to vertical. Now, I shouldn't say the way. There are lots of ways that we could enter this order. This is one way to do it. So I'm going to choose vertical here, and that pairs up the individual strikes one with the next. And I'm just going to go to the strike pair that we were looking at and click on the ask price to create that buy order. This is going to bring up in my portfolio, in order to buy and sell one contract, it's because I changed in my application settings my order defaults to just one option contract. These by default typically are 10. I changed it to 1. But let's figure out how much can we make or lose on this trade. So if we buy the 18th of July, 160, 165, bull call spread for 370, bold. At 370 is the maximum theoretical loss of this trade. We might wind up investing this and then losing it. So our theoretical maximum loss is 370. But let's say our trader just doesn't want to lose that much. We did lose that much on our Broadcom trade. But before I go into limiting that loss, using an order, hopefully limiting that loss, let's also discuss how much we might make. What's the theoretical maximum gain? So in this case, what we're doing is we're setting up a trade where we're buying the 160 call, selling the 165 call. When we own a 160 call, it gives us a right to buy shares for that price, the $160. When we sell a 165 call, we have the obligation at someone else's discretion. We might have to sell those shares at 165. So if we buy at 160, we sell at 165, that's a $5 profit except spent $370 to set that deal up. So that would be a $5 reward potential minus the $370 it cost to set up the trade. That's $1.30 per share. So this gives us sort of the facts of our trade. Here's how much we can lose per share. On one contract, it's 100 shares. Here's how much we can make per share. And on one contract, that's 100 shares. So in this webcast series, just as with our Broadcom trade, we typically try to keep our total loss potential at or below $4,000. So one contract would be $370. 10 contracts would be $3,700, and we could squeeze in going just a shade above 4,000. Let's do our 11 contracts again. So let's dial this up to 11 contracts. And here, let's see, our mid is at 360, our natural, ooh, look at it, just jumped on us. That dials up the cost of the trade. If it costs more to set up a $5 potential reward, it's going to reduce the total net reward potential of the trade. But let's see if we can get into this for a 370. Let's just slide that up there. That's going to lock us in. Notice the little lock here means that's the most that we're willing to pay for this trade. We might not get this filled. We're going to see. It's kind of jumping around on us. But if we set this off and then we turned our backs, I went on another vacation, we'd just have to see if the trade starts to falter. If the stock slips from where it is, it's up around $170. If it collapses and goes down through our vertical spread, we could just be looking at another maximum loss, another $4,000 loss. But let's say our trader just doesn't necessarily want that exposure. It still exists, but they prefer to minimize it if possible. How might they do that? Well, if we've invested $370, theoretically, the most we can lose is $370. Let's say our trader just says, well, even if I'm losing half of that, maybe I want to get out of this trade. How might we do that? By the way, Sia says, let me check your questions here. Sia says, is there any reason you're selling an in-the-money vertical? It's a good question. We've actually talked in previous webcasts about choosing between in the money or out of the money. In the money, higher probability, lower reward potential. You probably noticed on this trade that there is more that we can lose than we can make. But with these comparatively smaller reward potential trades, that reward is small because the probability of success is high. If we tilt it the other direction, if we prefer a higher reward potential, some traders do that, they may buy a contract that's out of the, buy a vertical spread that's out of the money. It's going to offer higher reward potential, but a lower probability of success. An out of the money contract literally means the stock needs to do something to get it in the money. In this case, it'd have to go up. And depending on how far out of the money we go, that would set how far up the stock needs to go. So it's sort of it's up to the trader's preferences. In the money, long vertical spreads are higher probability, lower reward scenarios. Out of the money, long vertical spreads are lower probability, higher reward scenarios. And for that latter, for the second scenario there, that's typically traders who are really confident the stock is going to do what they think it's going to do, and they want to leverage that reward potential. Okay, but yeah, let's get back to our trade here. And our assumption is hopefully the stock keeps going, stays above 165. Both contracts are in the money at expiration. We exercise at 160. We're assigned at 165. We make $5. But what if the stock starts to falter, as Broadcom did? And let's say our trader wants to just cut this one off if they've lost half of their invested value. They don't want to lose all of it. Let's try to keep it to half. Here's how we might do that. Just come down here where it says advanced order, change that from a single order to a first triggers sequential order. This is now going to be two orders. One's to get us in, the other one's to get us out if the trade is going against us. So first, the first order, if that first order, our buy order fills, it triggers a second or sequential order to go into effect. That's what first triggers sequential means. And that second order is going to be that exit order. Let's right click on the original and create that opposite order to close us out. Now, by default, this would be an order to buy for 370 and to sell for 370. That's not good, especially when commissions are being paid. That would be a loser. But losses are a possibility. In this case, though, what we're looking to do is stop the bleeding at half the value of our investment. We're going to call that, what is that, 185? Yep. Half of 370, 185. Let's make that a good till canceled order. So that's how this would be done on a long vertical spread. We look at the cost, the amount that we're looking to pay, and then set our stop at half of that. Now, this is starting to look like it's not even going to cost us 370. Maybe we could get in for 360. We want to try that? That's kind of, I'm going to stick with the original trade scenario. Yeah, Vic is pointing this out. We could probably get in a lower price. If we, now, that's nice. The price has gone down a bit, but what does that really say is going on behind the scenes? Our stock is probably softening a little bit. It's making the calls less valuable. That's why this trade is less expensive. Kind of in the very short term, the original premise of the trade isn't strengthening. If I were to go back and look at this chart, yeah, you can see a little bit firmer red candle there, but we're still up at 1%. Anyway, just wanted to quickly let's do that. Why not? Let's go ahead and dial this down to 360. If we do that, half of that value is going to be down at 180 instead of 185. Lois says, can you add this sell order if you already made the trade? Yep, you can, Lois. Yep. I'll show you how you might do that. But let's confirm and send this order. Buying those 11 verticals, 160, 165 call spread for $3.60. That's the maximum we're willing to pay. We'll see if we can get it filled. If we start to lose money, this is now drawing that line in the sand. And if we're on vacation, that line is still drawn all the way till the expiration of this contract. Good till canceled. Now, this is still going to say, Cameron, if you spend $39.60 on this, you could still lose the $39.60 if there was like a huge gap down day. This is not a guarantee that we will get out, like at worst case scenario, 180. Nope. This is just going to trigger an exit order, market order to get us out if the value happens to go down to 180. Now, regarding this stop order, there's a reminder down here, due to potentially wide markets or liquidity risks at the time of activation, this order, the stop order, may be manually substituted with a limit order upon activation and worked until filled. Okay. Now, there are commissions to be paid here. That cuts into the profit potential of the trade. But let's send that order off. See if we can get a fill. Yep, filled at 350. We were originally talking about 370. Lower prices on calls are due to a lower value on the stock. Now, that doesn't mean the stock's going to continue to collapse, but it might. But at least in this case scenario, in this case, the trader has decided to step away from the screen, go on vacation to not just have to commit their life to the monitoring of their trade. They know that they've at least taken what steps are available to them to try to reduce that downside. They haven't eliminated risk. They haven't even eliminated the maximum loss risk, but they've reduced that probability of maximum loss. So there we go. Guys, we've actually accomplished what we set out to do today. Oh, I said that you can add an order, right? Oh, I know what happened with our Gilead. It's down here under unallocated. Let's right click on that and let's move that to our long verticals and diagonals. There we are. Now we can see that diagonal there. And while we're at it, let's bump our Google position, move that to our long verticals and diagonals group so that we can follow up on that next week. But yeah, if we didn't have that original order in place, the way that might be entered is to right click on the existing position, right click here, and create a closing order to sell that vertical. And then we just customize this. So we could change this to a stop, dial that down to our 180, make that a good till canceled order, and send that off. Now, obviously, we already have a stop on this, so I'm not going to do that. But yep, that's how you can place and exit order on existing vertical spread. But anyway, guys, hey, thanks for giving me your time today. I'm going to let you go enjoy the rest of our educational offerings for the rest of the day. We have a lot of them on the slate. But also, I want to make you aware of how to optimize the resources that are available to you from Schwab Education. Number one is that if you haven't subscribed to our YouTube channel, do yourself a favor and do that right now. It literally only takes a second. It doesn't cost anything. You can go down and click on the subscribe button down the lower left, the lower right-hand corner of your screen there. But our YouTube channel is where we put all of these webcasts that we did as videos. So let's go to our YouTube channel. It's called Trader Talks Schwab Coaching Webcasts. And you can just go right to playlists. And this is where you can find the playlist for webcast series like this one. Let's scroll down and see if we can quickly find this one. It's, let's see, Brent, did you did you cover this while I was out? There it is. Yeah, there it is. There's Brent's face. Long verticals and diagonals. So you can go to view full playlist. And there we are. Look at how long I was away. 7 webcasts ago was the last one that I did. So it'll be fun to get this one back on. Brent, thanks for reposting that survey. Was there a survey? I thought so. Maybe there wasn't. Never mind. If you ever see a survey, make sure that you fill that out, giving honest feedback. That's definitely appreciated. No, not a survey. Carol says there was a survey, but there's not. In any case, thanks for giving me your time, guys. Make sure that you're subscribed to our YouTube channel. Also, make sure that you're following your favorite presenters on X. You can find us on X. You can find Brent there at Brent Morris CS. You can find me on X at Cameron May CS. And that's where we can just give you, market updates and things like that. When we don't have the luxury of having a live webcast going on at that moment. So it's the really best place to connect with us in between these things. Also, if you would, just click the thumbs up anytime you enjoy one of our webcasts. It gives a boost to that webcast in the YouTube algorithm, but also it's a nice pat on the back to the presenter for a job well done if you think they did a good job. So that's definitely always appreciated. All right, well, I'll look for you in a future webcast. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.